Calling all do-it-yourself ETF investors. Do you want to ring the bell at the Toronto Stock Exchange? Join us for ETF Investor Day, our first ever in-person event right here at the TSX on Thursday, February the 8th.
This investor education event will be focused on empowering Canadian ETF investors and providing informative content to help you navigate markets in 2024. There's going to be 3 exciting educational panels, which we've curated specifically for our ETF Market Insights audience. Our insightful guest speakers, who are ETF industry professionals, will provide you with the information and education you need to confidently manage your investment portfolio.
This will be an amazing opportunity to learn from ETF industry specialists and to network with like-minded investors while expanding your investment community. You won't want to miss this event.
Register today at etfmarketinsights.com.
We look forward to seeing you here with us in Toronto.
Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we're going to discuss the worldwide phenomenon, dramatic I know, of what is known as the home country bias in investing. So we'll dig into this and how it can impact your portfolio and how ETFs can be used to combat it. Before we get started, a quick reminder that we are not providing investment advice or recommendations. Our channel is all about providing education to individual do-it-yourself investors here in Canada. So today I am joined by Alfred Lee, Portfolio Manager with BMO ETFs, no stranger to the channel here. If you didn't catch his episode last week, every quarter on the channel for the past, year or so, we've been posting his quarterly portfolio review. So he's been running this model portfolio for over a decade now, and he walks through his market commentary and different shifts he's making within the portfolio. So make sure you check that one out. But welcome back, Alfred.
Thank you. Good to be here.
Great. Just to kick things off, I think we should start simple here and just provide us with an overview of what we mean when we say home country bias in investing. Like, what is it and why should investors be aware of it?
Sure. So home bias effect is basically when an investor basically has a preference for investing in their domestic market. So whether we look at Canada, US, basically just happens all over the world, no matter which market they are investing in. And the big part of this is due to familiarity. I'll defend my Canadian investors. I think, prior to 2005, there was good reason for this, not to date myself. But prior to 2005, there was actually a good reason. So the reason was that in RIF accounts and RSP accounts, there was actually a foreign content limit of 10% in their portfolio where they could not invest more than 10% in foreign content. So securities outside of Canada. That limit was later lifted to 30%, and then 2005 it was scrapped. In defense to the Canadian investors, back in those days, the only way to get exposure to outside of Canada securities was through mutual funds or buying securities directly, which could be very costly. Nowadays, as you know, there's ETFs where they could get exposure to broad international portfolios, emerging markets, individual countries such as China and India even. So we've come a long way, but still to this day, see a lot of Canadian investors with probably between 50 to 70% of their portfolio invested in Canada.
What is it of the whole world economy? It's like under 5%, right? So it's it's a
good question.
Yeah.
So
something like
I think when you look at statistically, so whether you want to reference versus the global equity market. So if you look at the MSCI World, Canadian equities make up 3.2%. Mm-hmm. From a global GDP perspective, it's less than 1%, as you say. So, if you are investing just in Canada, you are missing a world of opportunities. No pun intended.
Yeah, it's clear people are getting a little too patriotic out there. So talk us through some of the pitfalls of having a home country bias when it comes to your investments.
So when you look at, the Canadian market, Canada does several things very well. Finance, we do very well. Energy, we do very well. We're also known for materials as well. But when you look at those top three sectors, those make up about, 62% of the TSX. So the TSX being, the most widely recognized index that measures Canadian equities. When you look at the S&P 500, which measures, U.S. equities, it's about 54.5%. And when you look at MSCI EAFE, which is a measure for international securities, that's about 47.9%. So again, when you look at markets outside of Canada, generally what you'll find is that there's better diversification, or it's more well-rounded just from a sector perspective.
I think also, like, a lot of Canadians are employed in those major sectors too, right? Like,
yeah,
energy, financials, here we are, and just diversifying away from where you're earning your paycheck from is probably a pretty good idea too. Break down for us what like a Canadian focused portfolio looks like from a sector perspective versus global. Let's illustrate that for our listeners.
So when you look at Canada, as I mentioned, it's really made up of those three sectors. When you look at the S&P 500, it's much more diversified. So there's a lot of industries that, make up the U.S. market that we don't have exposure to. So technology is one good example. Healthcare, we really don't have representation, but it makes up a good part of the U.S. market. Even things like utilities and telecom, those are well represented in the S&P 500. When you look further outside of North America, so international stocks, for example, you're also getting exposure to things like consumer staples, consumer discretionary, which we really don't have exposure to inside of Canada. And beyond that, just beyond just sectors, you're being exposed to different economies and different companies around the world that that would benefit your portfolio overall.
Yeah, I think that sector diversification is key. What about the correlation between different countries' returns? How has that sort of looked or shifted over time?
Yeah, that's a good question. I'd say 20 years ago, that correlation between one country to another, or one equity market to another, was probably a lot lower. It's risen over the last 2 decades, and naturally because the flow of information. So the introduction of the internet, that was one thing, and then social media now, where information, once headlines break, it's basically known across the world simultaneously. So because of that, when you look at the equity markets, whether it's the TSX versus the S&P 500 or the TSX versus the EAFE, it's much more correlated now. So correlations will range between, I would say, 35 to 80%. But theoretically, when you're putting together a portfolio, anything that is less than perfectly correlated will benefit your portfolio. So, anything, as I mentioned, even with 30 to 80%, even though they're ebbing and flowing in the same direction most of the time, you're also getting the benefits of currency diversification if you choose not to hedge your currency through an ETF.
And I imagine if you're looking at shorter term numbers, it's probably even less correlated with, with everything that's going on in the world these days.
Yeah, for sure.
Or if you are looking short term, it's probably a different picture too. How about different economic trends and all these geopolitical factors that are going on in the world? How can those influence an investor when it comes to this common tendency of the home country bias?
I would say, when you look at Canada, again, when you're looking at those three sectors, they are what we call, I would say, old world economies. So things that are very cyclical in nature, the bricks and mortars to the economy. So finance, materials, energy, those are kind of like the building blocks to the economy. So during an economic expansion, what you'll find is that Canadian equities tend to outperform. So they are leveraged to economic expansion. But the flip side of that is that when we have an economic recession, or when the economy is shrinking, they're also overly exposed as well. So, again, by diversifying internationally, you're getting exposure to different economic cycles to a degree. But also, as I mentioned, we just don't have exposure to a lot of sectors that we don't have in Canada. So when you look at, the new world economies, for example, and you look at which sectors will drive economic growth in the future, It's things like technology, communications, also healthcare. So we don't have exposure to those. Technology, we have Shopify, but outside of that, we really don't have a technology sector. So again, getting international exposures is going to benefit your portfolio.
I think investors also probably read the news and they're freaking out about what's going on in all these different countries. And they're like, well, Canada seems okay. Like maybe let's just keep a big portion of the pie here. So break down for us some practical steps that investors can take to diversify their investment portfolio. Do we just follow this market cap approach or what can we do?
Well, they can use market cap approach, but there's different ways in which you can diversify away or reduce the home bias in your portfolio. So let's say you hold, that Canadian-centric portfolio, whether you get it through individual stocks, an ETF that looks like the TSX, or you're invested in an active manager that has through a mutual fund, more or less it's going to look like the Canadian market. What you can do is you could complement that with sector ETFs. So you could fill in those gaps, for example. So you could use a sector ETF that gets you exposure to technology, consumer discretionary staples, all those sectors that we're missing in Canada. So that's a good way to fill in those gaps. So I call that, more of a completion strategy. The other way to do it is essentially, getting, ETFs that track the S&P 500, international stocks, emerging markets. You could do it that way as well. The easiest way, I would say, is get an asset allocation ETF, then it's all done for you. It's basically a one-ticket solution. As you know, different risk profile, everything from conservative all the way to growth to all equities. And that's basically, put together for you professionally and then professionally rebalanced on an ongoing, basis as well. So that's a good one-stop solution. It's also a good quarter portfolio where you could actually add, more tactical positions on top of that as well.
Yeah, that's a good point. They definitely take the emotion out of it and from the rebalancing perspective and getting access to all those geographies is so important. Is it okay to have some bias in a portfolio? Like where are we going here? Is it going to be, we need to get down to 10% Canada or are we okay having some bias in the portfolio?
No, I think having some bias, I think that's going to be a natural tendency because people tend to invest in what they're familiar with. But again, to my point before, you are missing really a lot of opportunities by only investing in 1% of the global economy, right? So, again, not to use the pun again, it's a world of opportunities out there.
But you're gonna use it again. I love it.
I'm going to use it.
What are the considerations? Like, let's bring it back to ETFs. What should investors consider when they're looking at adding international ETFs to their portfolios?
So a couple things. So when you're trading ETFs, one thing I would say is best practices. So always keep that in mind. So the good thing about ETFs is that you could trade international markets during local time. So meaning that, you can buy exposure to European stocks during local Canadian hours. One thing to keep in mind is that when you invest in that, Europe is 5 to 7 hours ahead. So when you come in the morning, both markets are going to be open. So the bid offer spread in that ETF is going to be pretty tight. But when the local market is closed, so when the European market is closed, those bid offer spreads are going to widen out as well. So that's one thing to keep in mind. When the underlying market is closed, bid offer spreads will widen out a little bit. So best practice is try to trade when the underlying market is open. But again, one of the benefits of ETFs is that you could trade even when the underlying market is closed. The other thing I briefly mentioned is withholding taxes. So when you are talking about withholding taxes, there's 3 ways in which you get exposure to international stocks through an ETF. You could buy US listed ETF that invests in international stocks. You could buy a Canadian listed ETF that wraps that US listed ETF that goes out and buys international stocks. The last way is basically you could buy a Canadian listed ETF that buys the international stocks directly. So anytime you go through the US, you have to pay an additional layer of withholding tax. So when you invest in international stocks, there's withholding taxes on the dividends. So there's no way around that. However, by going through the US, either by buying a US listed ETF or by buying a Canadian listed ETF that wraps a US listed ETF, you're paying that additional layer of US withholding taxes. So that's one easy way to avoid that additional layer is just buying an ETF that invest in the local market directly.
Yeah, that's an important point. And I actually got that question from a viewer this week. So very timely. And there's more information on that on etfmarketinsights.com too, under our tax FAQ. There's a whole bit on withholding tax if you need to read through that again. But yeah, I think ETFs have just made it so much easier to overcome this home country bias. As you said, you can trade in these markets that might not be open and get the exposure you want. If you want to avoid certain countries, you can. You have that flexibility with different country-specific ETFs. If you didn't want to go the whole international market, BMO does have the largest international equity ZEA, or MSCI product there is the largest in Canada, but we've got lots of options if you're looking for more precise exposures. Thank you, Alfred, for joining me today, for walking us through your insights around overcoming this home country bias and steps investors can take. If you like today's show, please hit the like button. And if you have any questions, you can comment them below and we'll get back to you. But that's it for today. Thanks again, Alfred, and we'll see you next time. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.